host for the day. You guys should be able to screen share now.
Excellent. Thank you. Thanks, guys. Well, thanks, May, for setting that up for me. Hi. Hello. Welcome. Thanks for coming. Sorry, I'm just going to move something a bit. Technology is not my strong point, but Laura is, so that's okay. So thanks for coming to today's Fitbox session about the legal issues in fitness businesses. My name is Caroline E. I'm a tax and commercial law specialist at Blue Water Lawyers. Here are some members of our team, which I'll introduce you to shortly. But I'll get things started then. So today, my colleague David, so he's wearing a white shirt, which is not very ideal, but that's okay. My colleague David Tan and I will be sharing with you a quick summary of some common issues that we see in the fitness industry. So the first thing we'll cover is the common types of contracts that you will typically encounter. So these are generally commercial lease agreements, franchise agreements, and membership agreements. So he will touch on like what they are and what to look for in relation to these type of agreements. So I think that will be quite interesting in comparison to my part, but that's okay. The second part is about employment issues. So it's just in relation to when you hire a worker and to determine whether they're an employee or an independent contractor. So I'll touch on about the obligations that a business owner will have in relation to their employee or if they're an independent contractor. I'll also touch on how to determine what is the difference between a contractor and an employee. The third thing I'll cover is why is it even relevant? And the last topic I'll cover is business. Sorry, I'm just going to move this over. Yeah, maybe, sorry. Maybe I'll hide. Oh. Sorry, there's a part covering my screen, so I can't see it. And the third part I'll cover is business structures and tax. So what we will be looking at is what type of structures are available so that you may understand the differences and help choose which structure is most appropriate for your business. I'll also touch on whether you should change your ownership structure and some tax issues. But before I go into it, May will do something and help me fix this on our side, sorry.
I'll be for us to judge. Obviously, I've had a fair few Zoom fails so far, so I think these guys are used to my tech issues. You'll be fine.
Great, thank you. Well, May has fixed it. Okay, great. So we only have around an hour to cover this. So this will just be a general session, but it would hopefully give you a better understanding about the common legal issues and what to look out for. So before I get into this, I'd just like to quickly introduce you to some members from our commercial and tax team who are here in the room with me. So we've met Gabe, so give a little hi, wave, that's him over there. We've met May, hello. And then there's David, who's gonna, hello. Great, so here are some members of our team. I just wanna introduce to you a little bit about our firm. So Blue Water Lawyers is a boutique law firm with around 14 people. However, we have big firm capability. We specialize in commercial, tax, and family law. What sets us apart from any run-of-the-mill law firm, in my biased opinion, is that we focus on creating legal commercial solutions. So not just simple legal solutions are here, like, here's the work done, we're done, and we never see you again. We really want to tailor our solutions to the client. Our main client base is SMEs, so small to medium enterprises and individuals. So I will now pass it over to my colleague David Tan. He will kick things off about a summary about the common legal agreements. However, before that, I'll get him to introduce himself. So take it away, David.
Hi, everyone. My name is David. I'm an associate at Blue Water Lawyers. I do mainly with the property and commercial side of things. It's my area of speciality and it's my area of interest. So I'm pretty competent in this area, if you could call it that way. So today we're going to talk a bit about contracts in the legal and fitness industry. It's a very big topic, so I'm only going to be focusing on three main areas, which is commercial leases, franchise agreements, and membership agreements. So going into commercial lease agreements, there are four subtopics I want to talk about, which is heads of agreement, whether it's necessary or redundant, the commercial lease. Some of you might have had experience of that, and you'll notice that they're usually quite long. Why does it have to be this long? And pitfalls and potential traps in commercial leases. And the last bit, it's a little bit self-serving, but when you should engage a lawyer to look at your commercial lease. So I'm going to start with heads of agreement. What is a heads of agreement? It's not a binding agreement between parties. It's really for you and a potential landlord or agent to negotiate on big ticket items, just to see whether this lease is feasible or not. So you'll talk about things such as the commencement date of the lease, how much rent is payable, what the address of the premises is at, any incentives that the landlord is willing to provide to you, such as a rent-free period, or maybe they're giving you some money to fit out the premises, and any other negotiated terms. So it's really just a mechanism for you to have an informal discussion with people, just to see whether this lease is, this potential lease is something that you can go into, whether there's a meeting of the minds later down the track. Sometimes a heads of agreement is also called a gentleman's agreement or a commercial heads of agreement.
Sorry to interrupt, David. Guys, could I ask, does anyone here actually have a heads of agreement? Are you guys familiar with that? Cool, never mind.
No. Cool. So next thing we can talk about is what a heads of agreement is not. It is not a lease. It should not be a substitute for a lease, and we'll go into reasons as to why this is so. And finally, it's generally a non-binding agreement if properly drafted. So the next thing you're probably going to ask me is, if it's not binding, what's the point of going into it? So is it actually useful, or is it totally redundant? Just recapping a little bit, it's a way of recording the agreement between the parties before solicitors are involved. So it's not strictly necessary, because even if you don't have a heads of agreement, you can still enter into a lease later on. Sometimes people see it as an unnecessary extra step because it's like extra work. But at the same time, it is actually useful if you're negotiating special terms. For example, if you negotiated with the agent and the landlord, and they're willing to give you 100 grand to fit out the premises, it's something you probably would want to enter into, just to give yourself the comfort that, yes, this is what the landlord has said. And the landlord will probably like a heads of agreement as well, because then they'll feel like, yeah, this person is pretty serious about entering into a lease with me. So to answer the question whether it's useful or redundant, there is no straight answer to it. It's useful if you feel like you want the comfort of having negotiated terms put down on a piece of paper. But strictly speaking, it's not necessary, because you can still have the lease without having a heads of agreement. All right, so now we can talk about the actual lease agreement, why it is so long. So if you had a look at a commercial lease agreement before, it's 30 to 60 pages, and it can be quite chunky. But I think before we talk about that, let's go back a little step and ask ourselves, what is actually a lease agreement? What is actually happening here is, you, as a proprietor of a business, you want to operate your business out of premises. You might not want to buy your own place or premises to operate out from. So what you can do is, you can find someone who owns a place like that, and you tell them, hey, I want to use your place. I want to operate a business from here. What I can do is I'll pay you for it. And the owner of the premises would be like, yeah, that's a good idea for me, because I get money. I'm not using this place for anything else. Here you go, you can use it. But they're going to put some rules in place, what you can do from there, what you cannot do. That's essentially what a lease is. Now, is it really necessary to have that many rules, so that it's 30 or 60 pages long? Yes and no. I'll give you an analogy for that. Has anyone played card games before? Let's say Uno, for example. Maybe? No?
I love Uno.
Yeah. Essentially, it's a card game where I think you're given 5 or 7 cards from the start, and the aim of the game is to have you get rid of all your cards before anyone else. As long as everyone knows the rules of the game, it's really simple. Everyone just plays, it just goes on. But if someone were to do something contentious, such as, if you put a +2 card on top of the +2 card, sometimes people say you can do it. Sometimes, you say you can't do it. So what happens when there's disagreement as to, the rules or how something should be played? I'll tell you what I normally do. I normally fight like little children because that's me. But what I should be doing is I should be looking at the rule book, because that'll tell me whether it's something that can be done or cannot be done. Similar to a lease agreement, when everything's going fine, it's all good and everyone's hunky-dory. But if you were to do something and a landlord say, hey, I didn't allow you to do that, you have to look at the lease to see whether it's actually, something that can be done or cannot be done. So the lease is really essentially a giant rule book to say, really to regulate the relationship between the parties, whether something can be done, cannot be done, or something has to be done. Moving on. So there are many standard clauses in a lease. And what I mean by standard is it's pretty much how a normal lease would look like. What would constitute a breach of lease. For example, if you torch the place, that's probably going to be a breach of lease. It will also have standard things such as if you want to exercise an option to extend the lease, how you have to go about doing it. So a lot of these things in a lease is standard, but at the same time, some landlords or some solicitors tend to be a little bit sneaky or cheeky, and they try to tweak standard clauses. So it gives the landlord a bit of an advantage. And what I mean by this is it's pretty standard that the landlord would have rules about keeping the place clean, taking the rubbish out every day. And it's also pretty standard that they will have a list of items where they say this is a material breach of the lease, meaning if you breach any of these conditions, then we want the right to come back and kick you out and take over the lease, essentially terminate the lease. And one clause that I've seen recently was said any breach of the lease is considered a material breach of the lease. And the effect of that is if you fail to clear rubbish today, and the landlord finds out tomorrow, they can actually come back and kick you out and say, well, the lease is over. So even though having to keep the place clean is a standard clause, and a breach of the lease can allow the landlord to terminate the lease as a standard clause, it's a little bit unreasonable to say that if you fail to clear your rubbish today, the landlord can kick you out tomorrow. And that's one of the things where sometimes landlord and solicitors tend to make standard clauses too favorable for the landlord, and that's why we have to come in and make sure that things like that don't happen. So pitfalls and potential traps. As a tenant or as a business owner, the thing at the forefront of your mind is usually how much rent you're paying. And the landlord and the landlord solicitors actually know about this. So if they're going to come back and get you to pay extra money, they're not going to put it up front as rent. They're going to try and get you through a different way. And things that we normally see is the first one is the right to assign the lease. And what this means is if you have a lease for 5 years, and after 3 years you decide, hey, I don't really like this place, I want to move on, I found someone else who wants to take it over. Whether you can transfer the lease, that's essentially the right to assign the lease. Some leases don't have that, meaning you just stuck with it for 5 years. Next thing that they try to get you on is make good and redecoration. So what this means is within the lease, sometimes you have to repaint the premises every 3 years, 5 years at the end of the lease. And the extent and the scope of redoing the whole place could be quite onerous. Just to give you an example, if you're renting premises and it's really nicely decked out, there's like tiles, the walls are painted, what do you need to do at the end of the lease? Do you need to strip out all the tiles and re-put new tiles in? Do you need to repaint the premises? Do you need to take partitions down, put partitions up? Sometimes, at the start of the lease, it's not something that you really consider, but it can really add up at the end of the lease when you have to, go through the works and you look at it. It's like, wow, it's a $50,000 bill just to redo the whole area. The next pitfall is consent. So some things that you want to do under the lease, you need the landlord's consent to do it. And how do you go about getting the landlord's consent? How much is the landlord able to charge you for them to consider your, whatever requires consent? And to give you an example is fit out. So if you want to change anything, to reconfigure how the premises look, if you're going to put partitions up, that's something you usually need the landlord's consent. Usually what we try to do is we try to make sure that there is a cap as to how much the landlord will charge you for it, because otherwise it can charge you a pretty large amount of money, which is not what you want. And the final thing is car parking. Usually it depends on where the premises is at. You might have exclusive use to car park. You might not have exclusive use to car parking areas. Some places they'll say, well, you can't actually use any of the car parking areas because it's all for customers. If you want to use it, here's a different document. It's called a license agreement. You have to pay me extra money for you to use the car parks here. So depending on where you're at or what you're trying to achieve, if car parking is really important to you, this is something that you usually have to look at. All right, and the last thing is, it's more of a legal thing, which is registering the lease on title. And what this means is, when you do a title search on the property, you'll see who the owners are, if there's a mortgage over it, and if you register the lease, your lease will show up on title. So how does this impact you? If your lease is on title and the current landlord tries to sell the place, the new buyer needs to recognize the lease. Meaning if your lease is not registered and they sell the premises, the new buyer can say, well, I didn't know there was the lease in place. I'm not obliged to pay attention to this. So out you go. We don't want to recognize this lease. You don't have a lease anymore. So registering lease on title, it's not really a costly endeavor. It's usually $200 or so just to have it registered by the titles office. And it's something we always recommend you do if you have a valuable lease.
Sorry, Dave, I'll sort of jump in again.
Yeah.
Just in terms of, sorry, on your previous slide, I guess when we look at potential pitfalls and traps, and especially with make good and redecoration clauses, I think that's particularly relevant for this cohort. Obviously, gyms have a lot of infrastructure that need to be installed. So commonly we're looking at drilling into walls, changing flooring, having stuff hanging off the roof. I mean, for the guys who are here as participants, have you guys ever had any issues with landlords in like make good or anything like that, alterations to premises?
I've made a few, but my landlord's been pretty good with alterations. He's pretty much, I haven't had any issues with it so far. He hasn't charged me for anything that I've done with alterations, but I do have some other issues, but I'll keep them for some Q&A questions at the end.
I think you're a good landlord, pal.
Yeah, no alteration issues. I wish I had met these Blue Water guys 12 months ago, because we went through a hell of a drama with our landlord. We now own our property, which is awesome. But we went through a really tough time, but through it now. But a lot of this stuff would have been helpful 12 months ago.
Better late than never, they say.
Yeah, that's it.
Shay, I know you guys are looking at probably even, outgrowing your premises a little earlier than planned. So it's probably a few of these things that'll be good to keep in mind.
All right.
Yeah, we got none of that. Our landlord has just basically said do whatever, and I'm not even sure we have a proper lease.
Okay, there's some context for our guys today.
Yeah.
All the lawyers in the room just had a heart palpitation.
Yeah.
Awesome. Always good to know for the guys to have an idea of who we're talking to, of course. Sorry, David, I'll let you carry on.
All right, no worries. Okay, so when to engage a lawyer? I'm not sure how people are going to like this if I say you don't really need a lawyer all the time, but it's always recommended. And why I say you don't need a lawyer all the time is you can always just go out, sign a lease. You don't get a lawyer to look at it. You still have a valid lease if it's properly done. But what that means for you is you may or may not know everything that's happening in the lease. It's not always a good thing that you just look at the rent and everything's fine, because as some of you have experienced, make good and redecoration. It's something that you might not have looked at when you're signing the lease, and when it comes to the end of the lease, it's going to cost you a big headache. So solicitors are usually encouraged, to be engaged. And when you normally engage them is before the actual lease is signed. You don't have to get them involved when you're doing a heads of agreement, because again, it's not binding. It's really just for you to make a record for your comfort. But solicitors will get involved before the lease is signed. Once it's signed, it's a little bit too late. So get them involved before it's signed. They'll review the lease to provide you with advice on your obligations and point out clauses where it's a little bit unusual. And usually there'll be some amendments to be proposed to make it a little bit more balanced in your favor. And the next thing I was going to say is you should engage a lawyer who is experienced in this area, simply because not every lawyer has the commercial acumen to know what to look out for, what's really in your interest. And sometimes clauses, they're not clearly black and white. It's unfair to you, or it's not favorable for you. Sometimes it's a little bit gray. So a more experienced solicitor will be able to see the grayness in it and try to make things a little bit clearer, especially to make sure that you're not overpaying anything at the end of the lease. Alrighty, so now I'm going to talk about franchise agreement. This may or may not apply to a lot of you. It's if you run a franchise business, it would be. If you don't run a franchise business, maybe this will sway you to decide to become a franchisee in future. But anyway, we're going to talk about the benefits and limitations of being a franchisee, what the franchisee contracts are about, and some things to be aware of. So the benefit of being a franchisee, minimal experience is required simply because the franchisor will provide you with training on how to run the business. They'll provide you with goods and equipment, or the supplier details as to where to get goods and equipment. And you can also rely on the brand name of the franchisor. So it's very easy to become a franchisee and operate your business from there. You don't need very much. You just need to be able to afford the franchisee fees, afford the equipment, and just be willing to run the business there. The limitations though, and it's almost like a double-sided sword, double-edged sword of benefits, because even though you don't need much experience, the royalty and similar fees are quite substantial. Whatever amount that you're making, it's not going to be as much as it looks like at the end of the day, simply because once royalty and all the other fees are taken out, you don't usually have as much as if you made the same amount of money running your own business, not being a franchisee. There's also restrictions on how the business can be run. The value behind a franchise is that they're standard across the whole country. So if you go on the Macca's in Cairns, you go to the Macca's in Sydney, the Big Macs don't look the same. They're going to taste the same. They're going to be pretty much exactly the same thing, which is pretty much the same as a franchise agreement if you're in the fitness industry. If you go to brand A franchise in Cairns, brand A franchise in Sydney, the equipment should be the same. The staff attire would be the same. It should look almost exactly the same. So you can't spice things up by saying, I'm going to change this. I'm going to make this a little bit different. I'm going to make it better, quote unquote. You just have to follow what the franchisor dictates that you're supposed to do, and you have to stick with it pretty strictly. Any changes by the franchisor, if they want to change the logo, then you have to do it. You can't say, I don't want to because I don't like doing it. You really have to listen to what the franchisor is telling you to do to carry it. Okay, so franchise contract, it's subject to franchising code. So franchisors need to provide you with a disclosure document telling you a little bit about the franchisor, how they operate, if there's any litigation in the background, if they're getting sued by anyone, if anyone's suing them because of a breach of franchise agreement. It's just to give you an idea as to their background so you know what exactly you're signing up for and who you're dealing with. But at the same time, this code, it doesn't really create an equal playing field, because at the end of the day, the franchisor still holds the majority of the power in the relationship. And what this means is that in a franchise agreement, which states the amount of royalties you have to pay, the amount of promotion fund that you need to contribute into, they're generally quite unwilling to negotiate on those terms simply because it favors them heavily, and there is no real requirement for them to negotiate with you, because realistically you're trying to rely on their brand name. You kind of need them more than they need you type of relationship. So it's not always a very fair playing field. Some things to be aware of. The contract term, like I mentioned, it favors the franchisor very heavily. And one example is this franchise called Back in Ocean Physiotherapy. They had a restraint of trade clause. And what that means is that if you were a franchisee and you left the group, you don't want to be a franchisee anymore, they restrain you from opening a competing practice for a period of 12 months within a 10 kilometer radius of any franchise store. They were really popular. I'm not sure if they still are. But what this really meant was the only way that you could get around this is to A, not work for 12 months because they're all over the place. B, move rural because every city in the city, pretty much, there is one within a 10 kilometers radius. Or C, pay them out for this clause, which is 4 times the annual royalty fee, which can be a really massive amount. And the ACCC looked into this. They say, well, it's kind of unfair. We need you to do something about this. The franchisor eventually had the term removed, but it was only after 15 years when it first started. So for 15 years, there are people out there who either couldn't practice for 12 months within the city, have to move rural, or they have to pay out 4 times the annual royalty fee, which if it's $100,000 a year, 4 times makes it 400 grand, which is a lot of money.
I should say that, like, interestingly and applicable to this group, and I'm not sure how familiar you may be with CrossFit as a business structure, but all 3 participants here today are affiliates of CrossFit. So they pay a sanctioning fee to the head governing body to get use of the logo and the trademark and that kind of thing. But other than that, they are largely hands-off in terms of how you run your gym. So it's kind of like you get the benefits of the franchise with, being part of a network and the logo and that kinds of thing, but you also get a large amount of freedom as to how you can run your own individual business and put your own stamp on it. So I think that probably appeals to a lot of our guys who have here today. They're all being independent business owners. But yeah, I think you probably nailed the right decision. If franchises haven't appealed to you and yet you're under CrossFit's banner, it makes sense.
Right. Another thing I was going to say about franchise agreement is the leases, like we spoke about before. Sometimes franchisors, they will enter into the lease for the premises, and when you decide to be a franchisee, they'll pass the lease on to you. They'll do so under a document called a license agreement, which pretty much would mimic what the lease is, saying that you have to comply with the terms of the lease. But sometimes they might tack on additional terms in their favor. So again, something solicitors should look at and let you know if you're being staffed on additional terms. All right, and the last bit is record keeping. Franchisors usually, the royalty fees that you pay them is usually a percentage of the amount of money that comes in. And the only way that they can really figure out how much money is coming in is that you submit your paperwork to them. So they have brought auditing rights to make sure that you're not, fudging the numbers or anything like that. Sometimes what they do is they can hire investigators to see the number of people going in and out of the gyms just to see whether, it tallies up how much you're declaring to them. One way just to make sure that everything is fine is just to have good paperwork, declare everything properly, and there should be no issues. What they normally do is, again, because they have the rights to be able to be a little bit more heavy-handed with the terms, they usually have the right to audit, and if they find any issues with under declaration, they'll charge you for the auditing fees, they'll charge you interest on the amount that's under declared, and it can really add up. So if you're a franchisee or plan to be a franchisee, just make sure your record keeping is on point. All right, membership agreement. So membership agreement, it's the agreement between you as the business owner and the customers that you have, your clients. And this relationship will be under a contract and is usually subject to Australian consumer law, the ACL. And what this means is that the ACL offers certain protections to consumers. And one of them, the biggest one for us, is unfair contract terms. And it's usually not very clear. Sometimes it could be unfair, maybe not. But just to give you an example of something that's clearly unfair, it's unilateral right to cancel, meaning, let me repeat that. Unilateral right to cancel, avoid, renew, or limit performance of the contract without allowing the member to do the same. Meaning, you can say, well, I'm going to renew your contract. You cannot say no. I'm going to increase your fees without telling you. It's $10 a month today. It's $3,000 tomorrow. You have no right to cancel. You just have to pay it. That is an example of an unfair contract term. Usually, practically, it's never this clear cut. So it really depends on what is in your actual document. If you need one prepared, you should always find a solicitor to make sure that you don't have any unfair contract terms, whether you do it intentionally or otherwise. What happens if you do have unfair contract terms? They are unenforceable, so you can't rely on them. And if a complaint is made to the ACCC, they can impose a fine on you. Okay, so the membership agreement is a pretty crucial document simply because it's the only contract that you're usually going to have between you and your members. And it's not something that you want to be constantly updating all the time. You know, like new members, I'm going to change this. Next new member, I'm going to change that. It's usually very standard. It's set and forget. So you want to make sure that all the terms that you want to rely on for the long term anyway is going to be in there. So it's just do it once, do it right. You don't have to worry too much about it. There can also be difficulties in updating contracts unless you know how it should be done, simply because you want to make sure that any changes also applies to existing customers, existing members that you have. So you need to make sure that your contracts allow for something like that to happen as well. So we do recommend that you engage someone to prepare membership agreements if you're planning to have them, or if you already have them, maybe get someone to have a look over them just to make sure that there's no issues with them. And if you are a franchisee, good news, you don't have to worry about this because franchisors will usually have their own set of contracts which you shouldn't be touching the terms of. So if you're a franchisee, just rely on what the franchisor has provided to you. Okay, that's the end of my part. I'm going to pass it back to Caroline, who's going to talk about employment now. So thanks, everyone.
Thanks, David.
Thanks, David.
Hello. So in my part of the session, I will be discussing about why it is important to understand how you hire your worker as an employee or an independent contractor, what your legal obligations are towards your employee or your contractor, and what on earth is the difference. So why is it important to understand the difference? So whether you're a business owner or a PT, it is important to understand the difference between a contractor and an employee. The reason it is important is because independent contractors have different rights and obligations to employees. So understanding the difference can assist you in planning to determine which is actually better for your business. To explain, an independent contractor is an entity, for example, a person, a company, or a trust who provides services to another person or business, as opposed to an employee who is a person you hire as, your employee or your staff. Another reason why it's important to understand is because it will protect your business from employment risks with tailored contracts depending on the obligations owed. So employment relationships are generally more heavily regulated The most common trap that we see in the fitness industry is actually the hiring of PTs and whether they are considered an independent contractor or an employee. For example, in my experience, we've actually seen some employers get this wrong and mistakenly treat their worker as an independent contractor when they're actually an employee. This has actually cost them a lot of money because they were imposed a 200% penalty for failing to pay superannuation guarantee, and they also had to spend a lot of money on costs to deal with an employment lawsuit, which is, quite costly. So as you can see, it is therefore important to get this characterization right. Obligations. So generally, I will share with you some information about some general obligations that an employer owes to an employee and the differences to a contractor. The first one is national employment standards. So if you're a business and you have an employee, you must meet the 10 minimum entitlements. So these are maximum weekly hours, request for flexible work arrangements, an offer and request to convert from casual to permanent employment, parental leave and related entitlements, annual leave, personal carer, sick leave, compassionate leave, community service leave. 8th is public holidays. 9th is notice of termination and redundancy pay. And the last one is to provide a copy of the Fair Work Information Statement. In contrast, if you hire your worker as a contractor, you don't actually owe them any obligations in relation to those 10 entitlements that an employee has. However, if you want to include that in contract, you can, but it's not necessary. The second obligation that you, if you hire an employee, is that you need to get insurance. So each state and territory in Australia imposes obligations for an employer to have insurance if it employs employees regardless of where you are in Australia. So in particular to Queensland, businesses must maintain an accident insurance policy to cover their workers against work-related injury or illnesses. This on the slide, it says what the insurance policy is for Queensland. However, all states and territories have very similar requirements. An employer is legally liable for compensation for injuries sustained by a worker employed by the employer. Therefore, it's very important to get that insurance. This is especially important for gym owners because the risk of injury is much higher. So therefore, it's very important to get insurance. For contractors, in contrast, generally businesses don't need to provide insurance for them because the contractors themselves would have insurance. However, there are some exceptions which we have seen some clients get tripped up on. For example, if you're required to PAYG withhold for that contractor, then you may be required to have insurance for them. So that is just a little trap, I guess, that some gym owners do not know about. So the next obligation is PAYG withholding. So what is PAYG withholding? It is an obligation for employers to withhold amounts from payments to employees to assist with their employees meeting their end of year tax obligations. So if you work as an employee, you'll generally have to withhold an amount from their payment. In contrast, for contractors, they generally look after themselves, so you don't need to withhold PAYG. However, there are some exceptions, and one of them is if they don't provide you your ABN, then you do have to withhold some payments from them. There are some other exceptions, but we won't go into detail because they're a little bit complex and we only have an hour. So the next obligation is superannuation guarantee. So superannuation, I think everyone around the room knows about it, but it's superannuation is money that employers pay to workers to provide for their retirement. So broadly, if you are a business and you have an employee, you're required to make quarterly superannuation guarantee payments on behalf of your employers to their nominated super fund, unless an exemption applies. So the minimum super guarantee amount is 10% of their ordinary time earnings. So that's just generally salary. And this is on top of their salary. So SG or superannuation guarantee obligations are quite strict and there are high penalties for failing to comply with them. In fact, if you run a company and you're a director, you could still be on the hook for unpaid super liabilities of the company. So it's something that if you are an employer and you do have employees, you should definitely meet them and pay them on time. For contractors, in contrast, you don't really need to pay SG for them. So it seems, as you can tell by the trend, it looks like employees have more obligations. However, there are some exceptions to paying SG to contractors. For example, the main one that we mainly see that people get tripped up on is when you hire someone principally for their labor. This may be particularly relevant, for example, if you hire PT to provide PT sessions for your gym members. So this is something you definitely want to flag in your contract to determine whether you actually need to pay SG or not. So you may want to get someone to look over your contract and your relationship to determine if you actually need to pay SG to that contractor. So this is a very common trap that we see that people miss a lot. Not exclusive to the fitness industry, but we see it commonly throughout all employers. And the last obligation is single touch payroll. So single touch payroll is generally a system where employers are required to register for it. So STP or single touch payroll is a type of software that reports an employee's salary, pay wage withholding, and superannuation information to the ATO. So essentially, this is a one-stop shop that the ATO requires so that they can track that you're doing the right thing. For contractors, on the other hand, don't really need it. So if you only hire contractors, you aren't required to register for STP. However, for employees, you do. As you can tell, that there are a lot more obligations that you have if you hire an employee versus a contractor. However, your business might suit employing an employee better than a contractor. So you really do need to consider all of these factors to determine which is right for your business. So, employees versus contractors. What on earth is the difference? Firstly, the most common mistake we see is that some employers assume that just because the contract states that someone is an independent contractor, it does not necessarily mean that that person is an independent contractor, especially when their circumstances don't meet the definition. In fact, it could be a very costly mistake. So how do we distinguish between them? So whether a worker is a contractor or an employee is determined by the nature of the relationship, not what the arrangement is called. So different factors must be considered to determine if a worker is a contractor or an employee, and you would need to consider it as a whole. Not all the factors need to be present for someone to be an employee or a contractor. So in this slide, it will just be a general guide. If it is not obvious whether your relevant worker is an employee or contractor, I really strongly suggest that you get advice. So here are some common factors that we see help distinguish whether someone is an employee or a contractor. So the first one is ability to subcontract and delegate. So employees generally aren't able to subcontract and delegate work. However, contractors, they can pay someone else to do their work for them. So essentially subcontract. Secondly, the second factor is payments. So employees are typically paid for the time work, so an hourly rate, or per item or activity completed, or commission-based. On the other hand, contractors are typically paid for the result achieved, based on the quote provided. Equipment and tools. So for employees, businesses provide all or most of the equipment, tools, and other assets required to complete the work. Or perhaps the employee is reimbursed for the cost of purchasing necessary equipment. Contractors, on the other hand, they provide their own equipment, tools, and other assets required to complete the work. They don't receive an allowance or a reimbursement for the costs incurred. However, as mentioned before, just because if some factors are present that suggest an employee, it doesn't necessarily mean that they are one way or another. Commercial risks. So employees don't take on commercial risks and the business is legally responsible for the work done by the worker and liable for the cost of rectifying the defects of any work. So that's why it's very important and why it's mandated by law that employers need to have insurance for their employees. On the other hand, contractors generally do take their own commercial risk and bear the legal responsibility for the work and are liable for the cost of rectifying any defect in their work. And that's why they, should have insurance themselves. Oh dear, I skipped it. Okay, sorry, went a little bit trigger happy then. So the next factor is control over work. So employees generally don't have the right to dictate the way in which the work is complete, but I like to digress, I do. However, contractors on the other hand, don't have freedom in the way they do have freedom in the way that work is done, subject to specific terms in any contractor agreement. However, if you do hire a contractor, you can determine a few ways that you would like your contractor to perform work for you. So it's just because they're a contractor, just because they're a contractor, you can still have a clause that helps dictate a certain way that their work should be performed. And the last factor is independence. So employees do not independently work from their business. They're considered part of their business. So for me, I'm an employee, so I'm considered part of Blue Water. And contractors, on the other hand, are considered to operate their own business independently. They perform services as specified in their contract or agreement, and they're free to accept or refuse additional work. In fact, they may work for other people as well. So for example, a PT, they may work for your gym, but they also may work for other gyms, and they are a very common example of a contractor. So on the next slide, I'm giving you a little example of what a typical employee is. So in this case, Blue Water Gym provides gym members with access to nutritionists. Harry Trotter is stationed at the gym from 6 to 10 and 3 to 8, Monday to Friday. He uses the office, computer and software provided to him, and he's paid a fortnightly salary. So in this case, Harry Trotter is an employee of Blue Water Gym. And on the other hand, so in another scenario, Blue Water Gym also provides gym members with different spin cycle classes throughout the week. Ronald Teasley is a little tease, and he is a spin cycle instructor and has a contract with Blue Water Gym to instruct three classes each week for the next 6 months. He's free to decide how he teaches each class, and at a rate of $80 per class. So Ron uses the studio and cycling equipment provided by Blue Water Gym. So generally, without considering if there's no other facts, he is generally considered a contractor for Blue Water Gym. But despite being a contractor, you may need to provide super for him. So it's a little bit tricky here. Does anyone hire anyone, any PTs as contractors or employees here in the room?
Yeah, I've got contractors and employees.
Yeah, okay.
Bit of both. Well, about to have both anyway, yes.
Yeah, both. Okay, well, that's good that, that this session was irrelevant, I guess. So the next part I will discuss is about structuring your business. So what are the different structures and how to choose the right structures? That's the first thing. Secondly, if you want to change your business structure, what are the tax considerations and what are non-tax considerations to think about? And thirdly, we'd cover something called about GST. So we initially put more, we covered more topics, however, we went a little bit too long, so we'll only talk about GST. So business structures, why is it important? So it is important to have the right structure for your business, as each structure has different pros and cons. In our experience, having the wrong structure has cost clients a lot of money down the track, such as paying additional tax when they really didn't need to. In summary, here are the main structures that we commonly see and some of their features. So a sole trader. So what is a sole trader? So it's simply just an individual who runs a business as a sole trader. So this is the simplest and cheapest business structure to set up and operate. The individual owns, operates, and controls the business. However, This also means they are legally responsible for all aspects of the business, and any debts and losses cannot be shared. A partnership is simply when two or more people distribute income or losses between themselves. So it's similar to a sole trader, except you're running it with an extra person or more than one person. A discretionary trust. So a trust is technically not a discrete legal entity, but it's a relationship recognized at law. Essentially, a trust is a legal relationship where the trustee holds assets on behalf of someone else or a beneficiary. A discretionary trust, or sometimes called family trust, is a type of trust where you have flexibility to choose who you want to distribute income to. So we find lots of clients like setting up discretionary trusts when they want a lot of flexibility. It's also very good for tax planning and estate planning and succession planning as well. Companies. So a company is a separate legal entity from their shareholders, and it's governed by the Corporations Act. Because it's governed by the Corporations Act, it may have a lot more disclosures and obligations compared to the rest. So that's a quick little summary about the main 4 structures. So I'll now talk to you about what are the factors to consider when determining which structure is right for you. So this is just a general summary, and there's a lot of factors, so we've just highlighted some key ones. So the first one is exposure to liability. So as a sole trader, you have unlimited liability for your business's debts. So if you're a sole trader and you also have a car in your own name, a house, a boat, and your business doesn't do quite well and a creditor comes after your business, your personal assets could be at risk. So that house that you saved a lot of money for could be at risk if your business doesn't do well. A partnership is similar, except it's unlimited between both parties. The liability is also joint and severable. So joint and severable means that the liability is shared between you and your partner. So for example, if I ran my business in a partnership and let's say the partnership owes a debt of 100K and I've paid my 50K. However, if my partner forgets to pay that 50K and decides not to, he skips over to Cayman Islands or something and decides not to pay for it, you are joint and severally liable for that debt. So even though you've already paid technically your 50%, 50,000, you're technically still up to pay for that remaining 50K. So that's just something to be aware of. Discretionary trust, the liability is generally limited to the trust asset and the trustee. And it's also subject to the terms of the trustee, which establish the discretionary trust. And lastly, private companies. So private companies, their liability is limited to the share capital that you invested as a shareholder. This means that if the private company, goes bust, goes bankrupt, then the creditors can't go after the shareholders' personal assets. So if you invested $10,000 in the private company, that means they can only go after the $10,000. Subject to certain exclusions here and there, like if there wasn't any material fraud or negligence. So private companies are generally a good idea for asset protection purposes to protect your individual assets if they're in your own name. Secondly, control over assets. So sole traders have, because they own the business, they have absolute control over their assets. Partnership, on the other hand, you have joint control. So both partners control all the assets. Discretionary trust. So a trustee, whoever's appointed as a trustee, so whether it's a person or an entity or company, that person or entity controls the trust's assets. And for a private company, it's separated. So you don't control the assets. However, if you're a director and determine, depending on the terms of your relevant shareholders agreement or constitution, the directors generally have control over the private company rather than the shareholders. So for a private company, if you are a shareholder and there are more than one shareholder, we would definitely recommend you to enter into something called a shareholders agreement. So a shareholders agreement regulates the terms and conditions for the, how the private company is run and the control over it. So, you could be running a company with your best friend and you might get along now. However, down the track, if something were to go wrong, and you want to separate the business, having a shareholders agreement is very important to minimize this risk, because it could be very difficult to separate from that former best friend if something were to go wrong. So we definitely recommend a shareholders agreement because only the directors have control over the assets. Third is compliance costs. So as I mentioned, sole traders generally have low compliance costs and they're quite an easy way to establish a business. However, as mentioned before, because they're cheap to establish, you have a huge, or not huge, an unlimited exposure to liability. So that is just something to weigh up. Partnerships, on the other hand, have low compliance costs as well, it's similar to a sole trader in that aspect. The only extra thing, or not the only, but another extra thing that you need to be aware of is that you do need to lodge partnership tax return. So that is an additional admin that you do need to do compared to a sole trader. Also I forgot to mention, with partnerships, because you're in a partnership with another person, we also definitely recommend you to enter into a partnership agreement if you don't already have one. If you are in a partnership, that is. And the reason why is because both partners have joint control over the assets. And because of that, you want to make sure that, if something were to go wrong, that the partnership agreement is there to protect you. And it also makes things much smoother as well. So, less fees. So the next one is compliance costs with discretionary trusts. So generally there are more compliance costs with them because discretionary trusts are generally more tricky. So there are more compliance costs with that, and private companies have higher compliance costs. And for example, there is an ASIC fee to establish it, and then there's also an annual compliance cost, so an annual ASIC fee that you need to pay to ensure your company is still registered with ASIC. There's also more obligations such as, financial certain obligations to, keep your records, preparing financials and tax returns and the like. So private companies do have a higher compliance cost. Tax rates. So sole traders are taxed at their marginal tax rate. So you may be aware that if you earn $18,200, then you don't have to pay any tax. And then it goes higher, so 19%. If you're within a certain certain income threshold, and then the next one is 32.5, the next one is 37, and then the highest one is 45%. However, if you're taxed at 45% and have to pay a Medicare levy, which is an extra 2%, if you're at the highest marginal tax rate, that means you've got to pay 45 plus 2, which is a whopping 47% of tax, which is not ideal if you're earning 180K and above. For partnerships, it's very similar. So partners are taxed on their share of their partnership income at their marginal tax rates. Discretionary trusts is a little bit more different. And as I mentioned, discretionary trusts, there is a lot more flexibility. This means the trustee can choose who and the amount that is received by each beneficiary. So the beneficiaries, if they do choose to distribute the income to them, is taxed at their relevant tax rate. So if the beneficiary is an individual, they'll get taxed at their marginal tax rate on the share of their trust income. And if they're a company, they'll get taxed their relevant company fixed tax rate. There's also something, so if the income isn't distributed and there isn't a very good clause in the trust deed, then the trustee could also be taxed as well, which isn't ideal, but that's just something to be aware of. And that's why there are higher compliance costs with discretionary trusts, is to make sure that the relevant tax planning has been made so that the relevant people are taxed in an efficient rate. And in fact, that's actually why discretionary trusts are commonly used, is for their flexibility in tax planning. So for private companies, their corporate tax rate is 25% if you're a base rate entity. So if you're a base rate entity, you generally earn 50 million or less. And if you earn higher than that, then you're taxed at 30%. So as you can see, if you are a sole trader and you earn over 180K and you're taxed at 47%, you might want to think, hey, look, maybe it's time to run my business through a private company because I'm only going to get taxed at 25% or 30%. So 50% CGT discount. So the CGT discount means you get to discount any capital gain by 50%. So a capital gain is essentially when, in very, very short and simple terms, is pretty much a large capital asset. So like gym equipment, or the most common one is your house. So sole traders, partnerships, discretionary trusts all have access to the 50% CGT discount, but private companies don't. So you might want to think about which structure holds certain assets because of this 50% CGT discount access. So to give you an example of how it works, so let's say I purchase a house for $10,000, and because it's $10,000, I must have purchased it a long time ago because there's no way houses cost that much. And then let's say I sell that house for 100K because COVID hit and suddenly the prices went down. That means I have a capital gain of $90,000. If I was an individual, a partnership, or discretionary trust, generally, that means I can claim the 50% CGT discount if I held that asset or that house for 12 months. So instead of paying $90,000 or paying tax on $90,000, I pay tax only on 45K. However, if I was a private company and I owned that asset and sold it, I don't get the access to the 50% CGT discount. This means I get to pay tax on the full 90K, which isn't ideal. So that's something to think about when choosing which structure owns certain assets. So commonly we may see that, one structure might own the land and then lease it to, the business structure. So like for example, you have two separate entities. One owns the land and the other runs the business. That's also a really good way to separate riskier assets. And the last factor I'm going to talk about is utilization of tax losses. So as a sole trader, you can utilize tax losses to offset against income in your personal name, and you can carry forward it generally. For partnerships, it's at the partnership level. So partnerships, the losses are contained within each partner. Discretionary trusts, the losses are generally quarantined to the trust. However, there's some potential for some flexibility, which I won't touch into here because it will take forever and I'll be here tomorrow just telling you about it. So, but generally there is some flexibility in relation to that. So that's why trusts are really good for tax planning. In private companies, losses are generally, quarantined in the company. This means if I had income and my business, which is run in a private company, had losses, I can't utilize their losses. It's just trapped in the company. So those are some main factors to consider when choosing which business structure is right for you.
Can I quickly jump in? I'm so sorry to interrupt.
Great.
I know we've run a little bit long. If anyone does need to hop off, by all means, feel free to. We will be still uploading this. But if you guys are happy to continue on, I'm certainly happy to keep going here, especially with one little question. And I'm sure the answer to this question will be depends. But is there typically a best practice business structure that you see for gyms of like the independent kind of size that we might have with the guys here? So if we're talking less than $200,000 in profit a year, could you maybe just really like broadly sort of speak to what might be the first place to start considering in terms of structure?
Yeah. So you're right. It really depends on the relevant person and the individual. So for example, if I wanted to set up a business and I was struggling with funds, I might choose to operate as an individual trader, as a sole trader, because that's the easiest and cheapest thing that I can do at the beginning. However, if I wanted to spend just a little bit extra, which is not too much, it might be more ideal to actually set up a private company. And the reason why I might want to set up a private company is I really think it's important to have asset protection, because I might own a house and I don't want my, something that happens to the company to affect my personal assets, because as I mentioned earlier, private companies have limited liability and are only limited to the shareholders' capital. So I guess broadly speaking, it really depends on your situation, and I guess a partnership might be suitable for two people and who aren't really looking to set up a company. And if I guess you have a lot of entities, or you have other entities that if you have a lot of entities and you might want to think about, or a lot of I guess adult children, you might want to think about setting up a discretionary trust, because there's a lot of tax planning opportunities that you can use with that discretionary trust to run the business. So I don't have a really good answer, and it really depends. So it just really depends on the person's circumstances, but that hopefully gives you a general idea. I'm not sure if that helped or not.
No, I think it does. Thanks.
Okay, great.
Because I think you're about to jump into that too, where it's the questions you need to ask yourself.
Yeah. Okay.
Apologies, I might have jumped ahead of you.
No, it's really good that you asked that. So I guess the next thing that I will discuss, and I'm going to fly through this hopefully, is changes to ownership structures. So sometimes you may start with the most appropriate structure for you at the time. So for example, a sole trader, but as your business grows, you may need to change your business structure. Other examples of when you might need to change your business structures, and there's an incoming business partner, asset protection, you want to sell your business, or your structure was really set up poorly in the first place because you didn't get really good advice. So here are some considerations, non-tax related, and some tax considerations that you want to think about in relation to choosing the right structure and whether you should change or not. So non-tax considerations. So some questions that you might want to ask is control over assets and income. So what is your end business goal? What are your commercial objectives? Do you want to sell the business? Do you want control over the assets or business now and in the future? And do you anticipate to build long-term wealth? If you eventually want to sell the business, perhaps a sole trader or partnership structure might not be ideal for you. For example, usually purchasers typically like to purchase private companies rather than from sole traders. But that's not always the case, but just generally speaking. The second non-tax consideration is exposure to foreseen and unforeseen liabilities. So as I mentioned, asset protection. So is the business considered high risk? So if you supply gym equipment, this might be considered high risk because of some manufacturing faults, and someone might be severely injured from the use of it, and you could be liable. So on the other hand, a business that might not be high risk is, a virtual assistant service or something. So they would have less risk and they probably won't be concerned about asset protection. But for gym owners, there is probably a high risk as people are undertaking, quite intense physical activity, and they have a high probability, touch wood that they don't, but they have a higher probability of injuring themselves when using the gym. So in that case, perhaps, if you could afford it, you might want to set up a company. The next factor or consideration is compliance considerations. What are the disclosure obligations that you're willing to accept? Because some structures might require more disclosure. For example, companies require more disclosure. However, are you willing to meet the cost to maintain that set of structure? So if you can't afford it, perhaps a company isn't for you. The next consideration is family and friends. So will you be starting the business with family or friends, or will there be an internal conflict within the family group? And the last one is future planning considerations, which I kind of touched on before, but what's important to you? Do you want flexibility? Do you want succession of the business? Do you want to pass your business to your children or some other family member? So if you do want to do that, pass on the business, maybe a trust is better for you. So those are the non-tax considerations. And after considering the non-tax one, here are some tax considerations. So the first one is, what is your taxable income? So as I mentioned before, if you earn over 180K, perhaps you might want to look to transitioning to a company. If you earn other income from other sources, you might want to consider structuring your whole portfolio, not just your gym business, but if you own a property development, if you own more than one business, I strongly recommend that you get advice to determine what your proper structure should be. Because if you do that, it will definitely be more tax efficient for you. And it'll probably be easier to maintain from an admin perspective as well. So the second one is, what are your anticipated expenses? Oh, sorry, I missed about availability of tax losses. So if you have tax losses, you can obviously offset that against your income. So if you have tax losses, you might decide, hey, look, I don't actually want to restructure immediately. I want to use up those losses first and then restructure later. So that's an example of how taxable income and tax losses could be a relevant consideration. The second thing is anticipated expenses. Are your assets, capital in nature, or are they trading stock? So if your expenses are generally deductible, so for trading stock, generally speaking, you can immediately deduct it in the year that you incur it. However, for expenses that are capital in nature, for example, renovation costs, generally speaking, they're capital, so you can't deduct that immediately, but there are certain exceptions. And the last one is business growth and potential restructure. So if you're planning to grow the business and you think you need to restructure in the future, there are some tax concessions available to you. So there's something called the small business CGT concession. So if you want to restructure, there's generally sometimes a tax cost to transfer your assets to a different structure. However, if you have access to the concession, that transfer that original capital gain of 100K may be reduced all the way by 50%. Sometimes it's reduced all the way to nil. So there are some little tax hacks here and there that do help reduce paying tax. Sometimes if you're lucky or not lucky, maybe you have good tax advisors, it'll get down to nil. So here's a quick little example. So Hermione Stranger has been a yoga and Pilates instructor for 10 years. She now wants to establish her own yoga and Pilates studio because she's sick of, being at Hogwarts. Her best friend, Neville Shortbottom, has agreed to help Hermione with the startup costs for the business in return for 30% of the profits. Eventually, Hermione wants to sell the business and retire in 15 years' time to travel the world because the wizarding world has a lot more to offer. So what structure would best suit Hermione? I probably might just answer this myself because we're running out of time, but here it is. So the best structure based on the facts, but it could change depending if there's more facts here and there, but generally speaking, the best structure for her would be just to set up a company. So here it is. Here's her company, HS, Yoga and Pilates Studio. And then she's a shareholder, 70% shareholder, and Neville Shortbottom is the other 30% shareholder, and they both own the business. And this would allow Neville to have 30% of the profits, and Hermione would have the other 70%. So as I mentioned, because they're a company structure, it would be important to have a shareholders agreement to help regulate and dictate the terms of how the company is going to run. So especially a shareholders agreement will be important for Neville and, our batteries are running low, would be important for both of them, just in case something were to happen. And lastly, we're at the end, some other tax considerations. So GST, when are you required to register for GST? So you are required to register for GST if you carry an enterprise, that's carry on business, that'd be in your case. And if your gross income from all your businesses is generally more than 75,000. So even if you don't meet that $75,000 limit, you can still register for GST, and there are some benefits to doing that. The benefits are you can claim GST credits on costs incurred in relation to your business. So for example, if I purchase a piece of gym equipment and it costs $10,000 plus $1,000 GST, so in total $11,000. If I was registered for GST, I could claim the GST amount, so that's $1,000. So instead of paying both $10,000 and $1,000, so $11,000, if I wasn't registered for GST, I only need to pay $10,000 and just claim $1,000 back. So it's really good for a cash flow perspective if you are claiming GST credits. Another positive is you don't need to monitor your monthly turnover. So if you haven't registered for GST and you expect your turnover to be closer to $75,000, you may need to monitor your monthly turnover. And the last thing is it's a little bit complex and a little bit tricky. Or you may already know about it, but it's something called going concern. So another positive, if you register for GST, is that you can sell your business as a GST going concern, which means it's GST free. Buyer doesn't need to pay GST on it, which makes it more attractive to them. And you can also claim GST credits on the sale as well, which means you get a refund of the 10% on the cost that you spend in relation to selling your business. The negative, however, as you may know, is that there are increased reporting obligations. So it's really a cost benefit analysis whether you want to register for GST if you don't meet that 75,000 threshold. So that's just something to consider. Lastly, we're at the end. So hopefully you've learned a lot or a little bit in relation to the common legal issues in relation to contracts, employment, and business structures and tax. And I flew through that very quickly. So let me know if you have any questions at the end, and I'll bring David back here. Did you want to come? Oh, okay, you have your own screen. Okay, never mind. Also, Hannah, Jess, and the fitbox team will send an email to everyone after our workshop with a list of services. So we generally charge a fixed fee. There are some fee estimates, and it has our contact details. In fact, we also will provide a 30-minute complimentary initial consult if you have some legal issues. Just please feel free to email May to organize a time. And if you scan the little code on your screen, it comes up with the little questionnaire to fill out if you do have a query. So does anyone have any questions?
Sorry guys, just to jump in first, these slides are actually up on your resources in the portal as well. So once we regain access to that, in case you've missed the code, you will have access to the resources, and I'll also pass on May's email if you want to book in for that consultation too. Back to the Q&A, Scott.
Yeah, I have a quick question. In regards to just a commercial property, so I got a shed, the roof is leaking quite bad, and the landlord refuses to fix it. Is it his responsibility or is it my responsibility?
Oh,
Sorry, David, you're on mute.
all right. Can you hear me? Okay. I think Caroline's computer died, so yeah. Let me recap. So you are a tenant. The roof on the property you're at is leaking, and the landlord's refusing to fix it.
Correct. And it's always when it rains, I basically have to shut the gym because it's unsafe for trade. It's right in the middle of the floor.
He's on mute. Okay. Is there a reason? Did he provide a reason as to why he said he's not fixing it?
Without being mean, he's just an old, very set in his ways. He's a pretty old sort of guy. Not an Australian. He's an ethnic, different nationality, and he's hell bent that it's not his responsibility. He won't do much on the shed. He's a bit of a pain in the ass.
Okay. So generally, things of a capital nature. So the building itself, it's the liability of the landlord to fix it, subject to wear and tear. If you're doing something to the roof, if you're attaching stuff to the roof and it's causing wear and tear, potentially it's not going to be the landlord's liability. But everything else aside, it's usually the landlord's issue to look into. If you're not fixing it, you probably can, enforce the lease against it. It works both ways. Again, it depends on what the lease says, how you go about doing all of this, and what remedies you have from there if he still refuses to fix it.
Okay. Cool.
So
Thank you.
in this instance, or in any other instance where there is a dispute between the tenant and the landlord, what would you recommend is sort of the first step? Is it that you should grab your lease and have a look?
Yes, if you haven't had a look at the lease yet, definitely look at the lease to see whether it's an issue that the landlord needs to fix, whether it's an issue that you as a tenant needs to fix. And from there, I think the next thing you can do is just open the line of communications with the landlord, saying, "Oh, this is the issue. It's a problem here. Let's try and fix it." Getting solicitors involved is usually a last resort because that tends to sour the relationship really quickly. So you can always get advice, but getting a solicitor to issue a letter of demand or anything like that on the other party, it's usually one of the last resorts.
Yeah, getting to that stage though, but I've checked the lease. I've checked the lease, and I know it's his responsibility. Not stupid. I know it's his responsibility. So it's going to be the next stage where I'm going to have to take on some. It's cost me probably in excess of about $14,000 or $15,000 and lost trade because the days I've had to close the facility where we can't run classes and can't let people access the facility over the last couple of years. It's cost me quite a bit of money.
Yeah, for sure.
Might be a good one to book in for that 30-minute consultation and get some direct advice on, I think.
I've actually got some other requests. I've only ever had contractors. I've just hired a girl. She starts next week. So I'm going to ask questions about that, but I'll save that for the 30 minutes.
Great.
Perfect. Shay's just looked out of the room. I'm so sorry. I can't remember. Is it Troy? It might be frozen, actually. I just want to check if these guys had any other questions as well, but it might be a bit of a connection drama.
Well, whilst we're waiting, the other question is, how do you check if your lease is on the title? Where do you go to check it?
So are you based in Queensland or was it?
No, I'm in the ACT.
I'm not entirely sure about the ACT, but in Queensland, you can do a title search. Find a solicitor, go on the titles office, do a title search, and you'll be able to see the leases registered there. In saying that, different states they operate a little bit differently. In Victoria, for example, leases are traditionally not registered on title. There is no option for you to do that. I'm not 100% sure on what the ACT is like. I know in New South Wales you can. So again, maybe not too helpful here, but it's something that's state related. So I can't really say whether you can search it out there.
No worries.
We might wrap it up there, I think, then, guys. Thank you so much for your patience. And I know we've run a little bit long, like I said, but I think that was awesome. That was a really good basic touch on quite a few things, and enough to get people really thinking about what questions they might reach out to you with directly in regards to their own situations. So thank you guys so much for giving us your time, and for those who are also on attendance here as well. Like I mentioned, we'll put up those resources on the portal once the portal access has been reestablished, and we'll let you guys know when that is as well. But thank you so much for your time and your help today, guys. Really appreciate your input.
Thanks, guys.
Thanks very much.
Thanks for attending. See you.
See you all.